For nearly 40 years, the world lived inside a financial illusion. An illusion so simple and so quietly powerful that almost no one outside the banking world ever questioned it, not reporters, not regulators, not even the governments that borrowed billions every week. Welcome to Money Moves, where we uncover the hidden truths behind the systems that shape your wealth, your debt, and your financial life. This is the story of how the biggest banks on earth quietly rigged the price of money itself. Not the price of stocks, not gold, not currencies, the actual cost of borrowing money. And they didn't need to cheat the system, because they were the system. For decades, a single number controlled the movement of trillions of dollars across the planet, a number most people couldn't recognize, pronounce, or even imagine mattered. It was called LIBOR, the London Interbank Offered Rate. It wasn't set by a government, it wasn't controlled by a central bank, and it wasn't even based on real trades happening in the market. It was based on something disturbingly fragile: trust. Every morning, banks like Barclays, UBS, JP Morgan, Deutsche Bank, and Citigroup were asked one simple question. If you had to borrow money from another big bank today, what interest rate would they charge you? They typed in a number, submitted it, and went on with their day. The highest numbers were thrown out. The lowest numbers were thrown out. The rest were averaged, and that average became the official LIBOR for the day. That single estimate determined the cost of almost everything: corporate loans, student loans, credit cards, government bonds, adjustable mortgages, and trillions in derivatives. Nearly $350 trillion in global financial contracts depended on that one supposedly objective rate. Economists called it the world's most important number, and yet it was built on nothing more than banks guessing what borrowing might cost them. It was like letting students grade their own exams and then rewarding them for scoring high. At first, the system appeared stable, efficient, and self-policing. But inside trading desks from London to New York, a quiet realization spread. If tiny shifts in LIBOR could move trillions of dollars, then the people influencing that number could make fortunes quietly, invisibly, without leaving fingerprints. And in global finance, opportunity is never wasted. The manipulation itself was shockingly simple. Imagine that 16 banks are submitting their daily rates. These numbers are averaged to create LIBOR. If a trader at one of those banks holds a huge bet that pays off when the rate rises, he doesn't need the whole market to move. He just needs LIBOR to move slightly. So he messages the colleague responsible for submitting the rate. Hey, push the number up a bit today. Or, can you keep it low this morning? With no oversight and no requirement for actual proof or lending data, that colleague adjusts the number by a tiny fraction, a few hundredths of a percent. Nothing noticeable. But on trillions of dollars of contracts, a few hundredths of a percent shifts billions, and the traders who nudged the rate get their payday. No one checked. No one asked questions. No one even thought to suspect that the world's biggest banks would lie about something so fundamental. It became routine, quiet favors exchanged through instant messages, emails, and the kind of casual conversations that sounded more like jokes than market manipulation. By the early 2000s, the cheating turned into open coordination. Traders across continents formed secret chat groups with names like the cartel and the mafia. They joked about fixing the fix, traded favors, swapped champagne, and bragged about how easily they could move the world's benchmark interest rate. These weren't masterminds. They were ordinary bankers, treating the global financial system like a game. Then came 2007 and the beginning of the global financial crisis. Banks were terrified. They didn't trust each other anymore. The interbank lending market, the market LIBOR was supposed to measure, had practically stopped functioning. But admitting that publicly would trigger a panic. So banks did the opposite. They lied. They submitted artificially low borrowing rates to appear healthier than they really were, hiding the fact that the financial system was cracking under pressure. One economist later joked that LIBOR during the crisis was like a thermometer reading 98 degrees, while the patient was in cardiac arrest. The system's heartbeat was flatlining, but the banks kept pretending everything was normal. Regulators saw the numbers and chose to believe them, because the alternative, admitting that the core of global finance was collapsing, would have been catastrophic. The truth exploded in 2012. Whistleblowers and journalists uncovered decades of manipulation, and Barclays became the first bank to confess. Chat logs revealed traders coordinating rate changes with the casual tone of friends ordering lunch. "Need Libra lower today, mate?" "Sure, no problem. You owe me one." The scandal spread across the industry. UBS, Deutsche Bank, Citigroup, JP Morgan, and the Royal Bank of Scotland were all implicated. It wasn't a single bad actor. It was the entire structure. Governments launched massive investigations. Banks paid billions in fines. A few traders went to prison. But the institutions, the actual architects of the system, survived untouched. They paid their fines, adjusted their public statements, and moved on. Because when corruption is complex and the victims are invisible, accountability becomes optional. To understand why this happened, you have to understand that the global financial system doesn't run on algorithms or perfect models. It runs on human behavior, greed, fear, ambition, reputation, and incentives. Libra turned human impulses into numbers, and those numbers into global consequences. When a banker submits a false rate, he doesn't just influence a statistic, he changes the financial cost of someone's mortgage, a student's loan payment, a city's pension fund, or a nation's debt burden. The manipulation wasn't victimless. It was a silent tax on the entire world. But the scandal barely made the evening news. There were no dramatic collapses. No iconic villains, no smoking guns, just tiny fractions of percentages nudged each day, draining wealth slowly and invisibly. That's the quiet genius of systemic corruption. It hides inside the routine. It blends into the structure. It becomes how things work. Libra was finally retired in 2023, replaced BS, OFIR, a new benchmark based on real market data from US Treasury transactions. Cleaner, safer, more transparent, at least on paper, but the deeper truth is that the same institutions still run the system. The same pressures still exist, and the incentives that created the Libra scandal have never gone away. Only the acronym changed. The Libra scandal wasn't about numbers. It was about trust, the invisible glue that holds global finance together. When trust becomes optional, the entire system becomes fragile, no matter how sophisticated its models look on paper. And maybe the most unsettling part is this: the manipulation never truly stopped. It simply evolved, disappearing under new regulations, new benchmarks, and new names. The cycle continues because the system rewards it. If this opened your eyes to how money really works, hit subscribe. History always has the answers. You just have to know where to look.